Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. Welcome to episode 34, Motivating Better Behavior with Annual Incentives. This will be an episode with just me without a guest. And for those of you listening on a podcast, it should be clear, but it might be better to watch the YouTube version because I am using slides as I go through this material. So our firm, Fortuna Advisors, helps clients by providing better insights by using measures that track share price performance better, and thereby being able to get a better sense of when value is being created and when it's not. Applying that to getting better decisions through strategic resource allocation and better tactical decision making. And then lastly, through better behaviors by incorporating our residual cash earnings measure into value-linked incentives, which is really the topic for today. So better insights, better decisions, and better behaviors. So the first problem with incentive plans is relates to measurement. And there are a couple of aspects to this. First of all, the measures that are used by most companies are incomplete and ignore important information. For example, revenue growth, how profitable was the revenue? EBIT or EBITDA, how much investment was needed? Free cash flow, are we discouraging investment? Free cash flow is the cash that you generate minus the cash that you invest. And so only investments that provide a full payback and more in the current year actually help free cash flow. But obviously, a lot of very good investments take more time to pay off. So free cash flow can be very stifling of good investments. And often you can tell a company uses free cash flow because they're among their peers. They tend to be underinvesting in the business. Often, to make up for the incomplete nature of the measures, they bundle together a bunch of different measures, and having too many measures starts to cloud the ability for people to clearly see what's happening. If there's so many different moving parts, how do you really know where the value is being created? And just to illustrate that, there's no way to combine the signals from different measures to produce one truth on whether performance has been good or bad. When you look, for example, at revenue growth rising, EBITDA margin rising, return on capital going down, and free cash flow going down, is that good or is it bad? I can construct good scenarios where these are the signals, and I can construct bad scenarios where these are the signals, because there's nothing to really pull them together and give you one absolute sense of, has value been created or has value been destroyed? And by the way, it's nothing specific to this. If I switch around the metrics and now have margin going down and return on capital going up, I still have no clarity. I can construct scenarios that are good or bad and have the opposite kind of, sort of signal. So this is one of the important reasons why we need better measures. The second problem with incentives is very often performance is measured against a target that is at least loosely related to the company's budget or business plan. And there's often some negotiation that happens, but performance against plan is what happens most of the time. And there are three big problems with measuring performance versus a plan. The first one, I think everybody's familiar with. It's sandbagging, which is the term used to describe people that understate what they think is going to happen so they get an easier target. And we call this planning for mediocrity. And unfortunately, when you plan for mediocrity, you often get what you plan for, which is mediocrity. So the second problem is target negotiations. When the business unit submits a plan that's understated, corporate then comes back and says, oh, come on, you can do better than that. And this big negotiation breaks out. And that negotiation has a lot of problems, one of which is it stifles the information flow. The business unit doesn't want to share everything they know with corporate because it'll be used against them in the negotiation, and they'll wind up with higher targets and lower pay. And so they start stifling information. Ooh, don't tell corporate that because they might use that against us. And how does that help corporate to have the stifling of information? It's really, kind of crazy. And then the third one is the year-end push, which many people probably hear those words and say, yeah, we need a year-end push. It's a good thing. And it can be, but it can be a bad thing too. Sometimes people, for example, pull January sales and profits into December in order to meet an objective. And they'll do so by offering discounts they wouldn't have had to offer if they just waited a few weeks. And so overall, you're making less money because of the plan. And people say, yeah, but then January will be worse. But by January, often we haven't even set the budget for the year yet. It's approved in like February or sometimes even in March. And so by the time you get to February, you're saying, yeah, well, our budget's got to be down because January was a bad month. And so, you get to normalize it out. And so lots of game playing can happen that's caused by these, by both by setting targets versus a budget and the fact that each year is its own island. Next year, we'll worry about next year's budget kind of thing. The third problem is crooked payout curves. And by that, I mean this. So if we have performance on the x-axis of a graph and the payout multiple on the y-axis, when you achieve target performance, you're going to get a payout multiple of 1.0. So if you had a target bonus, which was a certain percentage of your salary, you'd multiply that by 1.0 and your target bonus would become your actual bonus. And then what happens around that is where the problems really occur. So the first point to make is that most incentive plans, annual incentive plans, have a threshold. And when you hit that threshold, your bonus goes from 0 to a half. And people like that because they say, oh, if you do any worse than that, you shouldn't get anything. But that steep curve at that point creates a lot of gaming opportunities. Nobody ever just misses this threshold, right? Because once you're close to it, you're going to do everything you can at the end of the year to make sure you go over to the threshold. Even if there's negative ramifications for future years, you get paid a lot of money for that dollar that pushes you over the threshold. So the gaming is sort of at a max here. And if you're not going to hit the threshold, you can't play enough games to get over the threshold, you may as well write off everything you can, including the kitchen sink, because that's just protecting future years' profits. If you're not going to get paid this year, you may as well at least benefit the amount you'll get paid in the following years. Then there's a slope that goes up to the target. No real controversy there. But the slope beyond that often gets steeper because the distance to the max and the distance to the threshold is the same. But in one case, we're going from 0.5 to 1, and in the other case, we're going from 1 to 2. So the slope is twice as steep. Now, that leads to another gaming opportunity where that kink happens. Anything above the target is worth twice as much per dollar of improvement as anything below the target. So if you're on the steep part of the curve, again, you don't know where you're going to be next year. Maybe you should pull profit in January into December, playing those same kind of games in order to make sure that you get it, you get twice as much credit for it as you would have in January if you happen to be below the target next year. And then the last point is, when you get to a cap at the top, there's really no incentive to keep performing. In fact, if you do really well above the performance that would have led to the cap, it's just going to hurt your negotiation of your budget for next year. So that's kind of problematic. So the first solution to all of this is to use a better measure, and the better financial measure is some form of economic profit. Now, economic profit's been around for over a century. Alfred Marshall developed the concept, over 100 years ago, and I mean, he was brilliant. Came up with a lot of great economic principles, including producer surplus, consumer surplus, and so forth. But economic profit refers to the difference between total revenue and total cost, which sounds pretty basic. But that total cost includes the expected return of the investors. So we're going to take the return the investors hope to earn on their investment and treat it like a cost, like interest on debt. But we're not going to treat the expected return of the investors as a cost. And that has really important implications for the measure. Whereas accounting profit is only charged for explicit costs like interest, economic profit is charged for a full cost of capital, including the expected return of the shareholders. Again, treating it like any other cost. And the most popular version of economic profit going back to the 1990s is economic value added, or EVA. And this book was one of several that help explain what EVA is and how it's used. And I put this one on here because I actually wrote the epilogue for this book about EVA in the new economy, a chapter I wrote during the internet bubble, which is still very relevant today. But EVA, most popular version of economic profit, you may have heard of it before. EVA stands for economic value added. Now, we published an article a few years ago, some colleagues and I, called Driving Outperformance, the Power and Potential of Economic Profit, where we studied all the companies that mentioned some form of economic profit in their proxy statement in the executive compensation plan. And then we looked at how they performed versus their peers and versus the market. And lo and behold, the total shareholder return, or TSR, of the companies using economic profit in their incentive plans outperformed their peers by almost 5% a year and outperformed the overall market by 7% a year. That's pretty outstanding results. I mean, some of these companies have been using this for more than 10 or 20 years. To have that kind of annual outperformance on average is really, really quite outstanding. And in the article, I highly encourage you read the article. We also interviewed the managements of quite a few companies and got their insights on what they do differently, why they think they outperform the others. And so I think that's really good information. But this is fact-based evidence that companies that use economic profit on average do better than the rest of the market. Now, EVA I mentioned is the most popular form of economic profit, and it's good, but it's not quite as good as it gets. And I'll show you the problem with EVA. It took me a long time when I was a consultant actually implementing EVA companies to figure out what was causing them to underinvest in the future. And this is it. If you look at the total cost of owning an asset over its life, this is just the cost of one asset. It happens to have a 5-year life, just to make the example nice and simple. In the first year, you get charged for depreciation, that's the light gray bar, and you get charged for a capital charge, which is that expected return of the lenders and the shareholders. And you can see that every year that the asset depreciates away, the capital charge drops, so the total cost of owning the asset goes down. And then once it's fully depreciated, it becomes free. So when we look at the EVA, the economic value added now, given some forecast of revenue and profit, it's negative the first 3 years. It's not till year 4 that it turns positive, a little more positive in 5. And then it's, so unbelievably great in 6 and 7 after it's fully depreciated. You can see why people would be hesitant to invest in new assets because it takes so long for them to show up, as positive. And you can also see that, once an asset's fully depreciated, why would you ever replace it? You could be incurring tons of maintenance costs to keep that thing running, but it's still probably better than buying a new asset. Now, what we did to try to fix this problem was we created a measure called residual cash earnings about 15 years ago. And the measure is an economic profit measure like any other, but it's cash based. And so gross cash earnings is the sort of profit measure. And it's really like an after-tax EBITDA. There's 2 R's at the end of EBITDA because we capitalize R&D and we capitalize leases. We're taking rent out. And those help improve the quality of the measure. The lease adjustment's not that important anymore. A lot of the accounting changes in recent years have, for most companies, reduced the need for that investment. And R&D, we only adjust that when it's material and actually really changes the results. But you can imagine for a tech company, or like a life sciences company, it's a really important thing to treat their R&D as an investment in the business. When we charge the capital charge, the gross assets don't only include the capitalized R&D and the net assets, as you would see in EVA, but we add back the accumulated depreciation. So you're not being charged for depreciation in the gross cash earnings, and so the assets don't depreciate in the capital charge. And what's left over is residual cash earnings. And in this article, Beyond EVA, published in the Journal of Applied Corporate Finance, I showed that the changes in RCE, or residual cash earnings, relate to TSR better than the changes in EVA in every single industry. So it's a better relationship to TSR. And I'll show you now how it promotes better behavior. I'll go back to this graphic, which, by the way, is a graphic that's in my book, Curing Corporate Short-Termism. And if we now on the right side look at the cost of ownership in RCE, it's a lower charge in the first year. It's just a capital charge, right? And then that capital charge stays there forever. And so it's a sort of constant, sort of capital charge that doesn't get better as the asset depreciates away. So it's easier to make the decision to make an investment because the charge is lower the first year, and you only get benefit for improvement later if you actually generate improvements. You don't get a benefit from the non-cash, just depreciation of the asset. And we look at given the same sales and profits as the example on the left, when we look at RCE, in this case, it's positive from the outset. It's improving over the first 5 years. But then it dips in year 6 when the cash taxes rise. When you stop having the depreciation deduction, the cash taxes rise, and that drives the RCE down. So in the year when your cash costs go up, the EVA goes through the roof, the RCE goes down. I mean, it's just a better signal of what's really going on. You can see people would be more willing to make investments in the future and less fussed about replacing old assets that are getting old and crappy and needing a lot of cost of repair and so forth. So it's just simply a better measure. It's the same principles as any other economic profit measure, but it tracks TSR better and it motivates better behavior in terms of the trade-off between delivering performance now and investing in the future. So when we look at how different performance measures relate to total shareholder return, we've been publishing a value leadership report for a number of years now. And in that report, we show every year the companies that are top quartile on each metric, what percentage of those are also top quartile on total shareholder return. And as you can see here from the report in 2022, RCE improvement was number 1 on the list. You can see revenue growth was second. Further down, you see ROIC improvement and ROIC. And further down, you see things like free cash flow, which doesn't really relate very well to TSR at all. When we fast forward to the 2025 report, the RCE is still at the top, which is this modern form of economic profit we've been discussing. But what's interesting is ROIC was, toward the middle of the pack. Now it's second, and revenue growth was second. And now, with inflation, revenue growth has become much less important. Is down in the bottom half of the table. And so the other metrics bounce around. Sometimes investors want more growth, sometimes they want more margin, sometimes they want return on capital, but all that's captured in RCE. So that's why RCE tends to do well through all the ups and downs. And we've had RCE's been the top of this analysis since we've been publishing these reports a few years back, but we've also done the analysis going all the way back to the financial crisis. And in almost most of the years, RCE improvement is at the top. A couple of times it's like second or third, but on average it performs much better through all the up and down cycles we've had than any other measure in tracking total shareholder return. So we have more confidence that if you pay people to improve RCE, you're actually going to get strong TSR than we do with any other measure. So a lot on the measure, but we think it should be the only financial measure in annual executive incentive compensation plans. Now we can have other measures because there are other stakeholders or other safety things like that we need to motivate. That's fine. We're not saying not to do that. But as far as financial measures, the improvement in RCE kind of captures all the other drivers of value very well. RCE is a very complete measure. It captures growth, margin, and return on capital. It's a single measure that rises when value is created and declines when it's destroyed. And it combines the signals of all the other measures to produce one truth on whether performance has actually been good or bad. So the second solution, and it's facilitated by having such a good measure in RCE, is to measure versus last year. Stop measuring against plan and measure performance against last year. Again, RCE is such a complete measure with such a strong relationship to TSR that up is good and down is bad. You can't say that with any other measure. I can construct bad revenue growth examples. I can construct bad ROIC improvement examples or good ROIC decline examples. But pretty much no matter what you do, when RCE goes up, value has been created. When it goes down, value has been destroyed. So we always measure RCE against the prior year's actual. What that means is if you earn an adequate return on all the investments you make this year, your RCE will stay flat and you get a target bonus multiple. The shareholders got their expected return on their investment and you get your expected target bonus. It's a nice alignment and it's a simple kind of framework. When RCE surpasses last year, that means you created value. And so you're going to be paid a bonus multiple that's above 1 times your target bonus. And when RCE declines, you've destroyed value and you're going to get paid a bonus that's less than 1.0 times your target bonus. So there's a really smooth and good alignment here between the actual creation of value and the actual results. And we separate the incentive plan from the planning process, which frees the planning process up to be much more about, trying to find the best plan for the future. People become more willing to stretch. They say, okay, well, if we stretch, we can do this, this, and this. And if we achieve that, we're going to get paid 1.5 times our target bonus. In the old world, if you stretch, you're just making life more difficult for yourself. You're getting a higher target. But now they can figure out that by coming up with creative and aggressive plans, they actually create more value. Okay, the third solution is having a straight payout curve. And we talked about this kinked curve and all the strange behaviors it causes before. We straighten the curve out. And so you can see that every dollar from zero to the maximum is worth the same. And we even effectively benefit the behavior around the cap and around the floor versus the traditional plan by having an adjustment to that target setting mechanism I described on the prior page, where if you're above the cap, the target for the next year can never rise above what would have just barely achieved the 2x. So if you achieve higher than that, that's not held against you. It's only the point when you hit the 2x. And that significantly affects how people sort of behave when they're having a really good year. And the same on the bottom. If you're having a really bad year, there's no incentive from writing off the kitchen sink. The target's not going to go any lower than the point at which you hit zero. So that helps to motivate the connection of years together in terms of how people think about optimizing their bonus. So better measures, better target setting, and a better payout curve leads to better incentives, and better incentives motivate better behaviors that create more value. I hope you've enjoyed this episode 34, Motivating Better Behavior with Annual Incentives. If you have any questions, don't hesitate to reach out. We're happy to answer any questions that you have. You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.